So tax efficiency when buying property is actually quite a complex field of our law. Tax is very dynamic, and there's a lot of different components to it. But when we do look at tax efficiency from a property investor perspective, I always try and simplify it by looking at long-term efficiency, short-term efficiency. And remember, when I say efficiency, I'm not saying evasion. I'm not saying finding illegal or illegitimate ways of avoiding the payment of tax. These are all methods that are not approved, but they're contained in the legislation and they're allowable. And when we look at short-term and long-term tax efficiency, these are two very different components. So long-term tax efficiency is often when a person is doing their legacy planning. They want to find out how a property is going to move from one generation to the other. And we look at long-term planning, and we address taxes like estate duty, because these are the taxes that will come to be payable once a person passes away. Whereas your short-term tax efficiency are the types of taxes that one deals with on an ongoing basis, on a daily basis. And you try to find ways of structuring them so that they are not as cumbersome or as high as one would sometimes find in an inefficient structure. So, I mean, stupid examples of this is if a person in their personal capacity has a very high income tax rate as per the tax brackets, and they're paying tax at 45%, say. It might actually be a smarter idea to pay tax through a company rather, which is only 27%. And that is totally allowable. Companies are designed for the purpose of conducting business, and it does have a lower tax rate on income that comes in. Just bear in mind, then if you're trying to get money out of the company and you're declaring a dividend, for example, there are going to be certain tax consequences for the declaration of a dividend. In short, what I normally tell clients is there's efficiency, but the SARS and Treasury has obviously given this some thought. The same way that a person might want to donate assets into a trust, and donations tax is 20%. That's very similar to what the estate duty would be. So one way or another, you might land up having to pay tax at some point in time. The efficiencies come in realizing that if you donate, for example, into a trust, then you're paying a donations tax, say, at 20%. And at the very least, the asset is now in the trust. It's almost ring-fenced in the trust to the point where all the future capital growth is now in the trust. Meaning that if when you pass away 20 years later, the asset has grown by 300%, you'd be paying that 20% estate duty on an asset that's now far, far more valuable versus the 20% that you paid now if you had donated it. So small little considerations like that are what make the biggest difference in a legitimate tax plan to assist you in saving sometimes millions in tax, just because you've applied your mind correctly on which taxes would be paid when and how you can mitigate the amount of tax that you're going to pay.
Perfect. Thank you for that.